Hello, I'm Sabina CPA. I advocate less taxes and more profits. Today, I'd like to talk about losses that offer tax savings. Capital loss, casualty loss, net operating loss. A loss by any name causes a financial setback. It's something no one likes to think about, much less experience. But if you do suffer a loss, tax law may provide a measure of relief in the form of a refund or lower taxable income. Here are some examples of common losses you may experience along with possible tax savings. First is capital loss. Selling assets such as stocks, bonds, limited partnership interests, and collectible for less than what you pay for them can result in a capital loss. However, the loss can be applied to offset capital gains and then used to reduce ordinary income up to an annual limit of $3,000 or $1,500 if you're married and file separately. Any remaining balance can generally be carried forward to future years. Keep in mind that capital losses caused by the sale of investments within your retirement accounts are not deductible. Losses on the sale of personal assets, including your home, are also not deductible. Second, casualty loss. A tax deduction may be available to you when a sudden unexpected calamity like a wildfire or hurricane causes physical damage to your vehicle, home, furnishing, or other property, as long as it's a federally declared disaster area. For insured items, you would have to file a claim in order to deduct the losses, even if you know you won't receive money from your insurance company. The loss has to exceed $100. In addition, deductibility limits involving insurance proceeds, basis, and adjusted gross income apply. Remember, you may not receive a deduction for a loss that's reimbursed by your insurance. You may be able to amend your prior year tax return to reflect the current year loss and claim an early refund. This may result in lower tax for that year that could produce a refund, but it may also change the amount of your deduction. The next up is net operating loss. When expenses from your trade or business exceed your income, a net operating loss (NOL) deduction may result. If so, you can carry the net operating loss forward to reduce the tax burden from expected future income. The net operating loss deduction is limited to 80% of your AGI in future years. Any amount above the threshold is carried forward indefinitely until the entire loss amount can be fully applied. Tracking net operating losses amount that carry forward from year to year to ensure you are getting the maximum deduction. Lastly, gambling loss. Did you know that you may be able to deduct the cost of those weekly lottery tickets on your tax return? That's assuming you have gain from any type of gambling activity, but only if you itemize, and only to the extent of your gain. For example, if you have $5,000 in winning and $7,000 in losses, you'll be able to deduct $5,000. The $2,000 in excess loss is neither deductible nor eligible for carryover to future years. Differing eligibility and limiting criteria, as well as documentation requirements and restriction on transaction between family member and other related party, affects the deductibility of tax losses. Call for help sorting out the rules and getting tax saving from losses you experience. If you find this video useful, please click on like, subscribe, and forward to those who may also benefit from this tutorial. Please also head to baycpaplus.com to sign up for our email newsletter full of tips for less taxes and more profit. Until next time, God bless.